It was the morning of September 15, 2008. The air outside the Lehman Brothers headquarters in New York was thick with disbelief. Executives filed out carrying cardboard boxes, security badges, and decades of memories, while the world's financial system stood on the edge of collapse. Inside the trading floors, monitors flashed red, phones rang unanswered, and a storm of panic swept through Wall Street. The fourth largest investment bank in America was officially dead, and in just a few hours, over $600 billion in assets would vanish. But the real story didn't begin that day. The real story started years earlier, buried inside a scam so massive that when it finally unraveled, it didn't just destroy banks, it shattered lives across the globe. Before we dive into the deception that brought the world to its knees, tell me in the comments, where are you watching from, and what time is it right now? And if you love true scam documentaries, make sure to hit that subscribe button so you never miss another episode. Because what's about to unfold is a story of greed, arrogance, and manipulation so deep that it made the entire planet believe in a lie. At the start of the 2000s, America was intoxicated by the promise of the American dream. Owning a home wasn't just a goal, it was a right. Banks, lenders, and politicians all preached the same gospel: you deserve it. You can afford it. But what they didn't say was that they were building an empire on debt. The housing boom was a gold rush. Families who once believed they would never qualify for a mortgage were suddenly being risk-rated, approved for hundreds of thousands of dollars. Between 2001 and 2006, U.S. home prices shot up by over 120%, and nearly anyone with a pulse could get a loan. The dream of homeownership became a national obsession, and Wall Street saw it as the perfect product to sell. The secret weapon behind the boom was something called the subprime mortgage loans, given to people with poor credit or unstable income. Traditionally, those loans would be considered too risky to approve. But in the early 2000s, banks found a way to turn risk into profit. They began bundling thousands of these shaky loans together and selling them as mortgage-backed securities. These were marketed as safe investments, stamped with top credit ratings by agencies that were paid by the same banks selling the products. In other words, the entire system was built on a conflict of interest. Everyone knew the loans were risky, but as long as home prices kept rising, no one cared. The machine kept printing money. By 2007, the U.S. had issued more than $1.3 trillion worth of subprime mortgages. Behind every number was a family, people who trusted the system, who believed in the dream. But their loans were ticking time bombs. Many had adjustable interest rates that started low but exploded after 2 or 3 years. Entire neighborhoods turned into ghost towns. Houses sat empty. Weeds overtook lawns, and for sale signs lined entire streets like tombstones. The illusion of endless wealth was dead, but Wall Street wasn't ready to stop. They kept selling, repackaging, and trading toxic debt because every transaction meant another bonus, another paycheck, another profit. It was a global chain reaction of greed. In March 2008, the first major casualty fell. Bear Stearns, one of Wall Street's oldest and most respected firms, collapsed under the weight of bad mortgage debt. The government rushed in with emergency loans to prevent panic, but the damage was already done. By September, Lehman Brothers collapsed too, and this time there would be no rescue. The shockwaves hit every corner of the planet. Stock markets crashed, banks froze credit lines, millions couldn't withdraw money or pay bills. Within weeks, 8.7 million Americans lost their jobs, and 6 million families were forced out of their homes. Over $8 trillion in household wealth evaporated, gone as if it never existed. The headlines called it a financial crisis, but to ordinary people, it was something much darker. It was betrayal. A retired couple in Florida saw their life savings of $480,000 vanish overnight. A single mother in Ohio came home from work to find a foreclosure notice nailed to her door. Construction workers, teachers, small business owners, all victims of a machine that had gambled their futures away. As homes were auctioned off and families packed into shelters, Wall Street executives appeared before Congress not to apologize, but to ask for help. The government approved a $700 billion bailout, not for the people who had lost everything, but for the very institutions that caused the disaster. The public outrage was explosive. Millions demanded accountability, but almost no one at the top faced real punishment. The phrase "too big to fail" became a shield for corporations that had risked everything and lost nothing. Meanwhile, in the background, a handful of traders were celebrating quietly. They had seen it coming. They had bet against the very system they helped build, and when the world collapsed, they made billions. They weren't heroes, they were opportunists who turned a nation's suffering into their jackpot. And yet, their story is a crucial part of what happened next. The 2008 subprime mortgage crisis wasn't just a financial failure, it was a moral one. It proved that when profit becomes more important than people, destruction is inevitable. Millions of families paid the price for a crime they didn't commit. And still, no one truly went to jail for it. But what most people never knew, the part hidden behind boardroom doors and coded financial language, is that this entire collapse wasn't an accident. It was engineered. Certain insiders on Wall Street knew exactly what was coming. They didn't warn anyone. They prepared to cash in. When the housing bubble first began to crack in late 2006, the world hardly noticed. The headlines still spoke of record profits, record home sales, record optimism. But inside the glass towers of Wall Street, the panic had already begun. Analysts saw the defaults climbing, spreadsheets filling with red, yet the executives above them kept smiling. The machine was still printing money, and they intended to squeeze every last dollar out before it exploded. To them, this wasn't a warning, it was an opportunity. For ordinary families, the change arrived quietly. A late mortgage payment, a missed paycheck, an interest rate that suddenly doubled. But for the banks, it was the tremor before the earthquake. By the summer of 2007, mortgage defaults were accelerating so quickly that even seasoned lenders were stunned. Entire neighborhoods in Nevada, Florida, and Arizona turned into fields of for sale signs. Property values that had soared now plunged month after month, and the loans built on those values began to collapse with them. In March 2008, the first giant fell. Bear Stearns, one of Wall Street's oldest investment banks, had managed over $400 billion in assets only months earlier. In the space of a weekend, it was gone. Sold to JP Morgan Chase for barely $10 a share, a 93% loss in value. The shock rippled across the world. If Bear Stearns could fall, anyone could. Markets convulsed, investors fled. Still, bankers insisted the system was sound. They were lying. 6 months later, the inevitable happened. On September 15, 2008, Lehman Brothers, the 158-year-old titan of American finance, filed for bankruptcy with $639 billion in assets and $613 billion in debt. It was the largest corporate failure in U.S. history. The Dow Jones plunged 504 points that day, and another 777 points a week later, the biggest one-day drop ever recorded. Within days, trillions of dollars in global wealth had vanished. Retirement funds, college savings, and lifetime investments simply evaporated. The financial heart of the world had stopped beating. The human toll was staggering. In 2008 alone, 8.7 million Americans lost their jobs. Over the next 2 years, 6 million families lost their homes. The unemployment rate soared from 4.6% to more than 10%, the highest in a generation. Construction halted. Factories closed. Entire streets stood dark at night because their owners had been evicted. A family that had spent decades building a small business watched it crumble within months. Parents who had always told their children that hard work guaranteed safety could no longer make that promise. Each number hit a heartbreak. In Nevada, 1 out of every 54 homes faced foreclosure. In Florida, 1 in 6. The average American household lost more than $50,000 in wealth as home prices and retirement accounts collapsed. By the end of 2009, over $8 trillion in household wealth had disappeared. Families lined up at food banks, pawned wedding rings, and sold their cars just to keep the lights on. The middle class, the engine of the American economy, had been gutted almost overnight. While people packed up their lives, the architects of the disaster were preparing for rescue. The same banks that had built the bubble were suddenly too big to fail. In October 2008, Treasury Secretary Henry Paulson, himself a former CEO of Goldman Sachs, presented Congress with an ultimatum: approve a $700 billion bailout or risk total collapse. The plan, called the Troubled Asset Relief Program, poured taxpayer money directly into the nation's largest bank, Citigroup, Bank of America, JP Chase, and others, to keep them alive. At the same time, Federal Reserve Chairman Ben Bernanke slashed interest rates to nearly zero and began printing trillions through a policy known as quantitative easing. The goal was to flood the economy with liquidity, to buy time, to stop the bleeding. On Wall Street, confidence slowly returned. In Washington, officials congratulated themselves for saving the system, but to the public, it looked like betrayal. People watched the same executives who had gambled away the economy receive million-dollar bonuses for retention. They saw homeowners denied relief while banks were rewarded for failure. Protests erupted outside stock exchange buildings and bank headquarters. Angry citizens marched with signs reading, "Where's our bailout?" A question no one in power seemed eager to answer. Abroad, the dominoes kept falling. The United Kingdom plunged into its worst recession since World War II. Iceland's entire banking sector collapsed, forcing the government to declare national bankruptcy. In Spain and Ireland, property values fell by half, wiping out a decade of prosperity. The International Monetary Fund estimated global losses from the crisis at more than $15 trillion, a sum greater than the U.S. economy itself. Within 2 years, an estimated 30 million people worldwide had lost their jobs. Then came the cruelest irony. Within a year of the bailout, Wall Street was thriving again. Goldman Sachs, which had taken $10 billion in taxpayer funds, paid $16 billion in bonuses in 2009. JP Chase set aside $26 billion for compensation. The very institutions that had begged for government rescue were once again recording record profits. For ordinary citizens still trapped in unemployment lines, it felt like a second robbery. Congress held hearings, and executives appeared in expensive suits to apologize in polished sentences. But almost no one faced real punishment. Only a single mid-level trader, Karim Sorel-Den of Credit Suisse, would serve prison time for manipulating mortgage-backed securities. The masterminds of the crisis walked free, often richer than before. The emotional fallout was profound. Communities across America sank into despair. Couples divorced under financial pressure. Children changed schools again and again as their parents chased cheaper rent. Counselors reported spikes in anxiety and depression. A generation learned to fear debt, banks, and even hope itself. The crisis didn't just empty wallets, it hollowed out trust. By 2010, officials declared the recession technically over. The stock market was climbing again, and politicians pointed to recovery as proof that the system had been repaired. Congress passed the Dodd-Frank Act, promising stricter oversight and the creation of new watchdog agencies. But behind the scenes, Wall Street's engineers were already designing the next wave of complex financial instruments, derivatives tied to commodities, student loans, even carbon credits. The names had changed, but the motive was the same. Take the risk, reap the reward, and let someone else pay the price. In total, the 2008 subprime mortgage crisis erased an estimated $19 trillion in global wealth and pushed 5 million American families into poverty. It was the costliest man-made financial disaster in modern history, a crime without culprits, a wound without justice. For those who lived through it, the memory still lingers. The silent streets, the moving trucks, the shock of opening a bank statement and seeing years of work erased. For the wolves of Wall Street, it was merely a cycle, another chapter in the endless game of risk and reward. For everyone else, it was proof that when greed governs the system, the house always wins. And as the dust settled and the cameras turned away, the question that haunted the world was simple. Had humanity learned its lesson, or was this just the rehearsal for the next collapse? When the dust finally began to settle, the world looked nothing like it had before 2008. Skyscrapers still glowed over lower Manhattan, but the confidence that once powered them had dimmed. Ordinary people were left staring at the wreckage of their savings, wondering how a handful of bankers could nearly erase the modern economy in less than a year. The crash had ended, but the consequences were only beginning. For months after the collapse, the United States trembled. Unemployment hovered near 10%. Nearly 15 million Americans were out of work. Foreclosures continued to rise, peaking at more than 2.9 million filings in 2010. Families who had once lived comfortably now shared homes with relatives, packed into basements or rented motels by the week. Across the Midwest, construction sites stood frozen, half-built homes covered in tarps, silent reminders of the dream that had died. In cities like Las Vegas and Phoenix, entire subdivisions were abandoned. The lights dark except for squatters seeking shelter. Economists began calling them zombie neighborhoods. The social fabric of the country frayed. Anger turned into movements. In 2011, crowds filled parks and plazas from New York to Los Angeles, chanting, "We are the 99%." The Occupy Wall Street movement was born from the rage of a generation that had watched the system protect the guilty and punish the innocent. Students graduating into the worst job market in half a century marched alongside workers who had lost everything. They demanded accountability, but few in power were listening. Inside Washington, leaders scrambled to rewrite the rules. The Dodd-Frank Act, passed in 2010, aimed to tighten oversight, forcing large financial institutions to hold more capital and banning some of the riskiest bets. A new agency, the Consumer Financial Protection Bureau, was created to guard borrowers against predatory lending. The government promised that never again would taxpayers be forced to rescue reckless bankers. But Wall Street's lobbyists quickly went to work. Over the next decade, many of the regulations were quietly weakened, delayed, or dismantled. The reforms that were supposed to build a fortress ended up as a fence with wide open gates. Meanwhile, the Federal Reserve became the silent engine behind the recovery. It pumped more than $3 trillion into the financial system through bond purchases and kept interest rates near zero for almost a decade. Stock markets roared back to life. By 2013, the Dow Jones had not only recovered, but hit record highs. For investors, the nightmare was over. For millions of families, it never truly ended. Wages stagnated, the cost of living rose, and the dream of homeownership slipped further away. The recovery was real but uneven. The rich got richer. Everyone else treaded water. Beyond America, the ripple effects redrew political maps. In Europe, governments toppled under the strain of sovereign debt. Greece, Ireland, and Portugal faced brutal austerity measures as they sought international bailouts. In Iceland, citizens forced the resignation of their entire government after the banking system imploded. The crisis had begun in American suburbs but spread through every financial artery on the planet. Between 2008 and 2012, global economic output fell by an estimated $20 trillion, and roughly 30 million jobs were lost worldwide. The phrase globalization suddenly sounded less like progress and more like exposure. The human stories from those years still echo. Teachers who once planned to retire at 60 found themselves working into their 70s. Small-town mayors watched tax revenues evaporate as businesses closed. Nonprofits and local charities faced surging demand from families that had never before needed help. Across the U.S., food bank usage more than doubled between 2007 and 2010. Behind the statistics were millions of quiet acts of survival people, renting out spare rooms, selling heirlooms, taking night shifts, anything to keep afloat. Culturally, something broke. The old faith that the system works gave way to suspicion and cynicism. Surveys taken a few years after the crash showed record low trust in banks, corporations, and government. Documentaries, films, and books dissected the collapse, exposing the greed and negligence that had fueled it. The Big Short turned real traders into reluctant anti-heroes. Public outrage turned financial jargon into household language. Terms like credit default swap and bailout became part of daily conversation. Even people who had never owned a stock suddenly knew how fragile the system truly was. In 2012, the U.S. Department of Justice launched new investigations into mortgage fraud and rating agency misconduct. The results were underwhelming. Instead of prison sentences, banks paid settlements $13 billion from J.P. Morgan Chase, $16.6 billion from Bank of America, $5 billion from Goldman Sachs. The numbers sounded enormous until analysts pointed out that the same banks had earned far more in profits during the recovery. To many Americans, it felt like a fine for stealing the world. Still, some good emerged from the wreckage. The conversation about inequality, corporate accountability, and regulation returned to the center of politics. Grassroots organizations pushed for fair lending laws and affordable housing programs. Economists began questioning blind faith in deregulation. The crash had exposed the cost of greed more vividly than any lecture or report ever could. Yet the deeper wound remained: trust that the economy served people, not just numbers. Psychologists later documented the lingering trauma of financial loss, increased depression, alcoholism, and what some called economic PTSD. For millions, the fear of another crash became a permanent shadow. Even a decade later, surveys found that half of Americans still worried they could lose their homes if the economy stumbled again. By 2018, the global economy had fully regained the output lost during the crisis. But the distribution of that recovery was lopsided. The top 1% captured more than half of all income gains since 2009. The very institutions once rescued by taxpayers had become larger than ever. The 5 biggest U.S. banks controlled nearly 50% of all banking assets. The wolves had not been driven away. They had simply learned to wear better disguises. Looking back, historians describe the 2008 subprime mortgage crisis not just as a financial collapse, but as a moral reckoning. It revealed how fragile civilization becomes when greed outweighs responsibility and when complex systems grow faster than the ethics meant to guide them. The numbers are staggering. An estimated $19 trillion in global wealth erased, tens of millions of jobs lost, millions of homes foreclosed. But what cannot be measured is the loss of certainty, the realization that the guardians of the system were the same people who broke it, for the families who lived through it. Recovery was not about stock prices or GDP. It was about rebuilding dignity, one paycheck at a time. It was about saving again after losing everything, trusting again after being deceived. The scars remain, quiet and deep, etched into a generation that learned that safety is an illusion. And yet, as the markets rise once more and new bubbles form in technology, in cryptocurrency, in assets no one fully understands, the same question lingers in the air. Did we learn anything? Or are we once again building castles on sand, waiting for the tide to come in? This was the story of the 2008 subprime mortgage crisis, the $8 trillion scam. That shook the world. The greatest lie of modern finance wasn't that housing prices would always rise. It was that the people at the top would be held accountable when they fell. If you've reached this point and think this scam was unbelievable, just wait for what comes next. Subscribe to ScamSphere so you don't miss the next investigation, because history has a habit of repeating itself, and the next great con might already be underway.